We did touch $80 a barrel at some point in the last week, and it was mainly driven by geopolitics.
Let's put it this way. Bad news on the macro front trumps good news on the geopolitical front. Good news insofar as the price of oil is concerned, right? And so, we saw a huge rally, as Salih pointed out, in oil prices in the last couple of days. It's been back down, arguably because China came out with some weak macro data, and that sparked concerns on the demand side. So we have yet to see oil drilling pick up in response to the surge in oil prices.
The main read from that announced acquisition from Equinor, that's for a 9.8% stake in Ørsted that could go up to 10% once regulatory approvals come through. I think that endorses for sort of the long-term outlook for offshore wind.
We're rapidly approaching the point where solar plus wind, everything else is a rounding error.
But when we look at the oil price expectations for 2025, a bigger portion of the respondents, about 45%, said that a potential Trump victory would be bearish for prices, and that compares with only 18% who said that a potential Kamala Harris presidency would be bearish for prices. And
we asked several questions in the survey on demand, and one of the questions we've been asking for years now is around the idea of peak oil demand. Not because that's the sort of end-all be-all question for the market. There's a lot of factors. Just to keep oil production flat, you still got to invest. We're sort of quite knowledgeable about how the sort of industry works, but we tend to get shifting answers on that depending on kind of the zeitgeist of the moment around the oil market. And so right now, 5% of you and sort of the broader energy clients of Bloomberg think oil demand will peak by 2025, next year. So some people think it's imminent. About 38% think it's before 2030, and 76% see it by 2035. Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got Salih Yilmaz joining from his usual perch in Dubai, swinging over to Madrid. We've got Patricio Alvarez just back from a lovely trip to Texas. I don't think we'll talk about that on the call, but glad you made it safely home. Then swinging across the pond, we've got Scott Levine joining from New York headquarters at 731 Lexington. Okay, so today I think we should start with just a check-in on the global oil price. Just looking at the screen here, we're at $75 a barrel and change, which is a little bit of a pullback from where we've been over the last few days. Salih, let's come to you for that. What do you make of where the oil price is at? How much is geopolitics weighing on the market, and how do you read the tea leaves from where we're standing right now?
Sure, thanks, Rob. So, as you mentioned, we did touch $80 a barrel at some point in the last week, and it was mainly driven by geopolitics. Arguably that geopolitical risk premium is once again fading away. And what happened since the beginning of the month is that we had another direct attack by Iran on Israel on the 1st of October. And since then, we've been anticipating, and this has been well telegraphed, that Israel will have a response to that. And of course, the market has been looking at what this Israeli retaliation could target. And it seemed like oil facilities and the oil infrastructure in Iran could be targeted. And the main risk with that would be a further spiral of retaliation. Because, just what Iran is exporting may not be that much. I mean, it would be about 1.5 million barrels per day, which is a lot, but given the state of the market right now, one could argue that OPEC Plus has enough spare capacity to cover that shortfall if that scenario were to unfold. But the main risk there would be the cycle of retaliation that could follow, where Iran then could respond, and then they could target some other oil facilities in rival producers in the Gulf, and then in a more extreme scenario, they could block the Strait of Hormuz. Again, this is a low probability. It remains a tail risk, and it is a low probability but a very high impact scenario. So I think this is the reason that we saw in the last week or so this increase in prices. It was mainly geopolitics driven, and then it looks like the message that we're getting from the conversations between the US and Israel. We still don't know what the response will be, but perhaps it will not be on the key and vital oil infrastructure in Iran, which would obviously have not as big of an impact as the market may have thought initially. So I think that explains the increase and then the fading away of the geopolitical risk premium in the last week or so. Beyond that, I mean, there are still a lot of demand concerns, especially in China. A lot of traders are now talking about a potential paradigm shift in China, where given the turmoil in the property market and some of the challenges there, China may not actually go back to the pre-pandemic trend of just continued 1 million barrels per day or higher growth in oil demand. And that's concerning to the market. So I think we're just back to that dominating the market. And of course, we can talk about OPEC later on, but it's a big question also what OPEC will do next. Their next meeting is on December 1st, and it looks like a pretty well supplied market. So it's going to be very interesting to see if they decide to go ahead with their output hike and bring those barrels back into what looks like a pretty well supplied market. So with that, again, geopolitical risk premium fading away, and we're back to mid 70s for Brent oil again.
Thank you, Salih. So with that idea that we're well supplied, a big part of that narrative is the continued rise of U.S. output. And Scott, I want to come to you to get some perspective on that. Can you give us a sense, particularly given where we are with either Brent or WTI, how's this affecting drilling, fracking activity here in the States? Because I know you look after most of the drillers and energy service names. What's your expectation for those companies?
Yeah, so still subdued, I'd say, in the general sense. I think, the recent rig count readings have suggested that the drillers have not really responded to the surge in oil prices yet. Still waiting some evidence that it's sustainable, and it seems like, every time there's good news, let's put it this way: bad news on the macro front trumps good news on the geopolitical front. Good news insofar as the price of oil is concerned, right? And so, we saw a huge rally, as Salih pointed out, in oil prices in the last couple of days. It's been back down, arguably because China came out with some weak macro data, and that sparked concerns on the demand side. So we have yet to see oil drilling pick up in response to the surge in oil prices over the past month or so. What's interesting, actually, particularly in the last rig count update last Friday, we did see a pickup in gas rigs, and the price of Henry Hub, moved from $2 to $3 pretty much. It's pulling back a little bit now here, but that's a big move. And so we did see an increase in gas rigs over the last week or two, and so we are interested to see if there's more follow through on that side of the equation, and that included increases in both Haynesville and in the Appalachian basins. And so that does seem to be fundamental, or at least early signs that it's fundamental, and earnings season will probably give us a better indication of what the land drillers are seeing and expect there. But as yet, on the oil drilling side, at least as far as shale is concerned, we've yet to see, definitive stabilization. Certainly, we haven't seen a bounce in the rig counts yet.
Okay, very logical. I want to shift gears a little bit and bring Patricio into the conversation. So Patricio has a React out just the other day. If you don't know our Reacts, they're our sort of rapid fire analysis when some kind of new information comes out into the public domain, just a sort of first version of history. What does the analyst think about it? And so, Patricio, you've got a React on Ørsted and the idea that Equinor is going to be taken up to a 10% stake in the company. Tell us about that. I think it certainly shows that oil and gas names, particularly some of the European ones, aren't exclusively focused on oil and gas here at the moment. But I'm curious to get your readout on that particular development.
Sure. I think the main read from that announced acquisition from Equinor, that's for a 9.8 stake, a 9.8% stake in Ørsted that could go up to 10% once regulatory approvals come through. I think that endorses for sort of the long-term outlook for offshore wind, and after Ørsted has been facing several supply chain issues. It has faced the cancellation of landmark projects off the coast of New Jersey in 2022 and subsequent delays and cancellations in 2023. And since then, the company has reduced its end of decade capacity target by close to 30%. But nevertheless, if you look at sort of the renewables indices in the market, valuations are still well below their 5-year norm. And I think this acquisition endorses for the fact that over the long run, demand for renewable assets, for renewable power is still very much strong, both in the US and in Europe. Another thing that I think is worth noting is that probably Equinor's acquisition plays to its strategic strengths or operational strengths. That's because Equinor is an offshore oil and gas. It has a lot of offshore assets playing in the North Sea, and I think it plays to their operational skills as well. And it could help bring up, or let's say mature the supply chains as well. I think it's a good combination, and it endorses the long-term future for Ørsted.
Patricio, I want to probe a little bit more on that, just because the offshore industry, as you somewhat noted there, it's really kind of failed, I think, to sort of get a real foothold here in the U.S. And so I feel like we're already in a world where the U.S. gas market looks one way and the European gas market looks very different. Do you see this kind of continuation happening where you've got strong offshore really kind of continuing to gain momentum over there in Europe? And is it just going to be a slower pace of things over here? And let's bring in the election. How does a Harris versus Trump presidency play into your thesis on not just Iberdrola, but sort of the offshore space generally?
Sure. So let's say I'll start with Europe. So offshore wind in Europe is sort of the more mature markets outside of China. Offshore, you have the number one market is the UK, and it's closely followed by smaller markets in Scandinavia. So Denmark is another big, let's say, relatively big market, and it all comes down to policy and the maturing of supply chains. Just because you need to build out ports, you need vessels that are the right size. So I would say the execution risk for these projects is less, or there's less execution risk in Europe. And another major hub in Europe, for example, will be the North Sea and the Baltic Sea. But these are select projects, so we're not talking about explosive growth in offshore wind either. We're talking about a handful of gigawatts per year over the next 2 or 3 years. Now, if you look at the story in the US, Iberdrola actually just finished or completed their first offshore wind project in the US. It's called Vineyard Wind, and it's just under a gigawatt. It's about 900 megawatts. So that's huge, considering it was almost zero last year. So it's big in scale in the US. But in the US, there are a lot more hurdles. We don't have a supply chain. There's a lot more competition from other sources. State regulation differs from state to state. And then you also have federal permitting. So that's where I can bring in comments about the election. For example, if you look at a potential Trump presidency, former President Trump has been very vocal in opposing offshore wind. And one of the ways he could bring in another hurdle for offshore wind is by imposing federal permit moratoriums. And that would be similar to what President Biden did with the LNG moratoriums, which, that is a very tangible threat. And I think the US, of course, you have the IRA, the Inflation Reduction Act, sort of any change or reduction of the tax provisions in the IRA could not only hurt offshore wind, it could hurt onshore wind and solar. But in that context, I think that the last thing I could say that I think is important is that the IRA is sort of agnostic to what type of renewable energy you want to bring into the market. And in that sense, we've seen an explosion in solar. Solar is sort of the technology that we see being poised to capture most of the growth, and you can see most of the gigawatts being added or planned for additions in 2025 are mostly solar and batteries, and those are sort of the best place to grow faster because the lead times are shorter, they require less permits, there's less red tape, and you also have the policy incentive. So I think that sort of encapsulates the state of offshore wind, and why we don't think it's going to be huge growth. But we do see a long-term future just because it has higher load factors, and it could be quite complementary, but not as rapidly growing as solar.
Yeah, I haven't paid super close attention yet, but I think the IEA put out their latest renewables report this morning, and I think I saw some headlines that solar is going to be something like 80% of the capacity additions globally between now and 2030, something like that. I mean, gut check, that feels about right. So, I mean, we're rapidly approaching the point where solar plus wind, everything else is a rounding error. Salih, let's come over to you. Let's talk our own book a little bit. We've got a very cool survey that many of you listening participated in, I believe. And one of the sections from the survey asked about how the U.S. election could affect energy markets. We didn't just ask about renewables; we also asked about impact potentially on oil and gas markets. So, Salih, last time we had you on, we hadn't published this result yet. So, give us a sense of what the survey told us on how politics could feed into how folks should be thinking about energy markets.
Sure. First of all, yes, thank you to everyone who's taken the survey, who's taken the time to take the survey. It was a little bit longer than usual, but I think every single question that we had on there was very interesting, and the results, as we suspected, were very interesting. So on the election, as you say, we had a few questions. One was, what would the impact be on oil prices? And we followed up with a couple more questions on what would the impact be on US oil and gas production, on OPEC plus strategy, as well as on solar. And I should start by saying that there was a good portion of the respondents that said there will not be a meaningful impact on oil prices, on OPEC policy, or on US production. But when we look at the oil price expectations for 2025, a bigger portion of the respondents, about 45%, said that a potential Trump victory would be bearish for prices. And that compares with only 18% who said that a potential Kamala Harris presidency would be bearish for prices. And I think the answer in the following questions probably kind of explains that. It seems like more people thought that Trump would be pushing for more drilling, and the potential Trump victory could mean higher US oil production. And also more people thought that a potential Trump victory could result in an OPEC plus policy that has a looser output cut policy. So they perhaps hike output earlier or more if former President Donald Trump is in power again. And I think generally another reason could be that more people seem to think that there would be less strict restrictions on oil and gas in the case of a Trump presidency. So I thought, I mean, the rest of the survey was quite interesting too, but this was, I thought, this was the first time we asked, and obviously it was an election special. And I think the results were quite interesting because, you know, I think when we talk about this, and we've written a little bit about it, and we will probably write more before the election, I don't think it's black and white when it comes to what the impact might be. It's not that Trump is very pro-oil and Harris is very anti-oil. That's actually not the case, which actually made some of these results quite interesting.
Okay, Scott, let's swing over to you. I want to get your perspective. We've all been paying attention to the election, thinking about how it could impact some of the companies and markets we cover. So let's get your read. How do you see the election feeding into your particular corner of the energy patch?
Yeah. So personally, I think that Harris a Harris win is much more important for renewables and clean energy than a Trump win would be for oil and gas production and drilling activity. The reason I say that is because the renewables is much more policy dependent, whereas the oil and gas activity is much more driven by market forces. And so clearly, Harris has backed off the statement that she made in her last run that she is for a fracking ban. Beyond that, though, we haven't gotten a lot of clarity. Clearly, we would expect her to support, the same measures and adopt a similar philosophy to the Biden administration, which is obviously an integral part of, and that includes the IRA and, support for the energy transition and all of that. But she has backed off of some of the more anti-oil and gas platform planks from her 2019-2020 run. However, with Trump, we can debate, and I know that the department has written a lot about specifically what may happen in a Trump presidency insofar as the platform is concerned. I know Nathan Dean has done a deep dive on this topic, but generally speaking, while we could see some changes at the periphery and some rollbacks, some of the more, I don't know if extreme is the right word, but call it areas that, are still evolving and are still less proven, shall we say, whether it be carbon capture or, green hydrogen, things like that. By and large, in the Trump administration, so long as the Democrats have one of the houses of Congress at a minimum, we wouldn't expect, wide-scale rollbacks in some of those programs. And Rob, I know you probably have, your own thoughts on that subject. But sticking with the oil and gas side, Trump's, drill baby drill and that entire mantra and what have you. I think that, clearly the oil and gas companies are in a era of disciplined growth. I don't think that changes in a Trump administration. I think that continues in all likelihood. He could roll back some of the more onerous environmental safeguards and maybe engage in more favorable policy developments. Again, we don't see maybe the same policies we saw with Biden. He's cracking down a little bit from a policy standpoint on things like LNG and offshore drilling leases. So clearly a Trump administration would be more favorable for the oil and gas industry than a Harris administration. I just don't think it's as much of a difference maker as Harris would be versus Trump on the energy transition side.
Patricio put together some of the parts valuation on Iberdrola, and if I recall, I think you did it by geography and kind of used it to frame kind of how to think about the company here at the moment. So can you tell us about that note and tell us, I think, I'm curious a little bit as to which bits of the company you think are providing the most valuable component for the overall enterprise.
Sure. So the note is just sort of a review of a potential scenario of the sum of the parts for Iberdrola as a standalone business. The reason why we went ahead and did this is just because the company hit a record market cap a few weeks ago. It became the largest, well, the largest by far in the IBEX, in the local indices, and also it's the largest utility in the stock 600 utility index. It's no surprise. It's also it makes up the strongest EPS growth profile for the next 3 to 6 years, and that comes on the back of the acquisition of a UK grid utility company called ENW. And I think that's a good segue to go into where we see the value. So this company, Iberdrola, it's sort of almost perfectly split between renewable capacity, renewable power generation, and grids and networks. And why do we see a lot of value in this is because in the utility sector, we tend to favor or assign higher value for regulated earnings. And this company has sort of a 50-50% split between renewables and grids, and it's also sort of in the highest or the fastest growth jurisdictions. So we're talking about US. It has most of their wind capacity in the US. It has Avangrid, so they own a local utility in the US. They also now expanded in the UK, so US, UK, Spain, and Brazil. So Brazil is the fastest and largest market in Latin America. So it's both a composition, geographical composition, but also an asset mix. So Iberdrola has the largest onshore wind portfolio. They're quite big in solar as well, but the difference is that wind tends to be backed by long-term PPAs. So power purchase agreements that go beyond 15 years in tenure. So you can see that the company has a really strong sort of earnings quality composition. And we sort of, just to give you the conclusion where we got, is that the company, like the share equivalent of the scenario would be roughly 14 to almost 15 euros per share. It's currently trading at around 13.7, so we're almost right bang on where the company is trading at the moment. Though we did note some potential upside to the dividend payout. We think the company can pay out 75% of its EPS throughout the next three years, and consensus is a bit more conservative towards 70, and that just shows that we're a bit more aggressive on the potential synergies of the acquisition for grids in the UK.
Awesome. So I've just noticed that folks listening, you've been asking questions. I had that bit minimized. So let me actually take a couple of these. And Salih, we're going to come over to you first to get some insight here. So one of the questions from the chat. So feel free to put any call. We're happy to sort of respond to things that might be on your mind. But so one question that I thought would be good for you, Salih, is assuming Guyana oil comes online, OPEC Plus removes its production cuts, the U.S. continues drilling, will there be enough demand to keep oil prices in the $65 to $70 barrel range? And I'll just go ahead and throw in, maybe you can tie that into the results of our recent survey, because we did ask about where prices could go at the end of next year.
Yeah, absolutely. I mean, I think it's a very good question, and it very much depends on what your outlook is for demand. The very near-term outlook for demand on the street right now seems to be relatively bleak. Like people are quite concerned about where demand is, because I mean, demand has been underwhelming compared to many expectations at the beginning of the year, and this is why I think a lot of market participants are rethinking what the demand numbers might be for next year and perhaps for the rest of the decade. And I mean, Guyana is, I think the expectations from Guyana is that they could add another 1 million barrels per day between now and 2030. I mean, adding to that, Namibia is very early stages, but could be another Guyana. Brazil is ramping up. I mean, the question mentions the US. As long as prices are where they are now, this is obviously incentivizing producers like the ones in the US shale. So, and I think the key in the question is, while all of this is happening, if OPEC Plus removes its production cuts, what happens. And I don't think if OPEC Plus were to remove all of its production cuts, oil prices would be at the $65 to $70 a barrel that the question is asking about. I mean, we've done some analysis on what the quarters next year could look like in terms of the oil market balance if only the core OPEC member nations bring back all of their supply. And it would be a massive glut. I mean, that would result in an extremely oversupplied market. And that's for next year. I mean, you could argue that demand will be so good beyond next year, and maybe that balances the market, but that's looking unlikely. So linking this back to two of the questions, as you said, from the survey, one question was, do people think that OPEC Plus will have to keep an active supply management in place? And a big majority said yes, at least from time to time, they will have to. And my opinion on this is that at least in the next few years, it looks like they will have to keep perhaps not the level of cuts that they have right now. Perhaps they will be able to taper these cuts a little bit, but I don't think they will be able to remove all the cuts in the next year or two. And then the other question that you alluded to, what the expectations are for oil prices. The majority for this year where they think oil prices will be at the end of this year, majority said that almost 90% said it will be below $80 a barrel at the end of this year. And almost half said that the oil price will be below $70 a barrel, which I thought was quite interesting at the end of this year. So clearly, again, I mean, this is a pretty good question, I think. And when we just focus on even just the very near term, it looks like the outlook by many right now is that demand is struggling. There's too much supply. OPEC Plus is in a very difficult position to bring any barrels back. And if they do, they would probably be bringing back barrels into a pretty well supplied market, at least in the next quarter.
Thank you, Salih. And I'll just quickly add, we asked several questions in the survey on demand, and one of the questions we've been asking for years now is around the idea of peak oil demand. Not because that's the sort of end-all be-all question for the market. There's a lot of factors. Just to keep oil production flat, you still got to invest. We're sort of quite knowledgeable about how the sort of industry works, but we tend to get shifting answers on that depending on kind of the zeitgeist of the moment around the oil market. And so right now, 5% of you and sort of the broader energy clients of Bloomberg think oil demand will peak by 2025, next year. So some people think it's imminent. About 38% think it's before 2030, and 76% see it by 2035. So there is this expectation that this idea of just demand growth just continuing to go up and to the right won't continue. At some point, we could see a real shift there and sort of a change in kind of how to think about it. But anyway, check out the survey. Very cool set of results. Salih, that lives on the OPEC dashboard. So if you go to BI OPEC, is that the best place to find that?
You mean the survey?
Yes.
Yes. Yeah.
BI OPEC. Yeah. Go check it out. Scott, let's come over to you then. And I want to get your read just on how we're about to go into the 3Q earnings cycle. What are the big themes and questions you think are going to be of focus as the management teams disclose results and kind of give guidance on what comes next?
Yeah, I think the initial most important question is probably getting an early read on 2025. It's too early to expect definitive guidance, but certainly investors are going to be looking for early insight. And I think preliminarily speaking, the expectation would be somewhere, that we'll see growth next year, but it's somewhere in the single digit range. And in all likelihood, North America, I think, preliminarily speaking, the outlook for upstream CapEx, to be clear, this is what my companies trade on and care about. The expectation would be next year is better than this year, but this year is something like down 5%, give or take. So if this year is down 5%, then flat next year is good, or up from this year. Conversely, international, I think the expectations that it's probably lower, the spending growth next year. And so this year, just to put a point on it, roughly speaking, is up 10 is probably the consensus view, maybe up 5 to 10% in terms of upstream CapEx growth in markets outside of North America. Next year, I think maybe at best it's that. Maybe it's more like the lower end of that number. So the lower end of that number at 5% and North America at flat, you're looking at low single digit growth expectations for the market next year for total spending growth and CapEx. And that doesn't sound great, obviously, in the grand scheme of things. But I think, maybe up 5 to 10 is an okay place to start if you're thinking about what guidance can end up looking like globally for upstream CapEx. And one thing I'd add there, just as a plug for my colleague Vince Piazza, just put out a deep dive on E&Ps, and what's going on in the market there. What we believe is weighed on North America, in addition to the slowdown in shale. Production is still growing, but we've seen a huge wave of consolidation there. And one of the bull case arguments we hear from our companies is that once you see this last wave of consolidations complete this year, that those rigs get released, and if oil prices remain favorable, however you want to define that, based on what Salih was saying, but we start to see some of those rigs come back into the market, maybe picked up by some of the smaller independent guys that can make money at $70 a barrel, or maybe better if the markets are accommodating. So I think that's probably the most important thing we're looking for this year, and certainly much more important than the earnings that we see out of the companies. But I think that's probably the most important thing. We have Schlumberger reporting on Friday, and Liberty reports next week. They're the second largest fracking company as well. So those are probably an early indication as canaries in the coal mine.
Fantastic. Thank you, Scott. And I appreciate that you mentioned Vince's new deep dive. We messed up. We should have had him on this week to talk about his new report. And I believe next week he's going to join to go deeper on that. How do you get the deep dive? Just BI space deep go on your terminal. It's a 40-page PDF. And it's got some very provocative views on the US E&P space. All right, let's do a quick roundup. First, we'll come to you, Patricio. Let's just do a quick check-in. What are the key themes for you as we head into the earnings cycle? What do you think the sort of discussion is going to be on your space?
So in the utility space in Europe, I think 2023 set a very high bar for earnings comparisons, just because there was a lot of cost recovery from the energy crisis. So in 2022, they have very elevated power prices that caused a lot of supply margin strain, and a lot of that has been recovered in 2023. So we expect integrated companies to see healthier margins in this upcoming earnings cycle. And I think the main piece, or where it becomes a bit more interesting, is looking at power generators. So that we do see a bit of not opportunity, I would say upside, or maybe a dislocation between what the price assumptions were for these companies back in March when they set their guidance for the full year. And gas prices have been a key driver in that divergence. Gas prices are up roughly 25% year to date, despite being well below their records in 2022. And we don't think that consensus analysis is quite right in capturing the power prices that will flow into these companies for 2025. We think perhaps there's a bit more headroom for upside revisions for generators, and we're talking about independent power generators. We're not talking about the large integrated companies like Iberdrola, where things look very stable. And as usual, this is utilities is a stable, unexciting sort of sector, but perhaps power generators could see some surprises.
Okay, Salih, we'll come over to you for last word. Give us your read. What are we going to hear about 3Q, and what's ahead for your?
Sure, I'll be trying to brief. I mean, what I'll be watching, what will be very interesting for me is going to be downstream. We know refining margins are normalizing, but the pace of normalization very important to see. And then when it comes to chemicals, I mean, we have been expecting an improvement and recovery in margins, which have proven to be quite slow and gradual, but we're expecting that to continue. So a lot of the companies that we cover, a lot of the integrateds in Europe and here in the Middle East have exposure to refining, and some of them have exposure to chemicals. And, upstream, of course, very important. Some of our companies like OMV has exposure to Libya. I mean, obviously, a lot has been happening in Libya in the last month. They had a political rift over the leadership of the central bank. The two rival governments in Libya have been fighting over that. But in the last couple of weeks, they seemed to have reached an agreement, which is positive for me. But it will be very interesting to get their thoughts on some of that, and of course some of their thoughts on and guidance on where they think oil prices might go in the rest of this year and next year. But the most interesting thing for me is going to be downstream, what's going on with refining margins and what's going on with chemicals margins.
All right, thank you. I think we'll leave it there. Just a quick reminder, if you want to join for those deeper discussions on election impact, just reach out. We're happy to get you the details for a very much in-depth discussion that will involve our folks and team there in Washington, D.C., as well as some of the industry analysts that here on the call. Maybe second, I'll just flag that we do have a couple of in-person European events coming up. I know Patricio and I and our colleague Will Harris will be doing an event in Madrid the week before U.S. Thanksgiving, which probably doesn't mean anything for Europeans. But Patricio, do you know the date off the top of your head? 21st?
Yeah, yes, November 21st.
November 21st, Madrid event. And that week, we will also have an event in London, or around that time. We're still trying to figure out what day we're going to do our London event. But so for anyone, we know where you're at. Some of you are in Europe, some of you are in London. So if you want to come and say hello to us in person, we hope you come and meet us for that. And lastly, I'll just say for anyone else who's in Florida, I hope you're safe from the Hurricane Milton that's coming through. I think I'm lucky. I don't think it's going to affect where I'm at too much, but definitely hope that you're safe from the storm. And look forward to being in touch. So again, next week we're going to have Vince Piazza on, most likely to talk about his deep dive. And reach out if you need any help navigating the terminal, or if you want to talk about any of the research or topics we chatted about here today. Take care, everyone.